Hi everyone, we are going to start a new lesson today, the pricing. And the marketing mix, another most important element of marketing mix is pricing. Because one of the most important, the key thing when the customer goes to shopping, when the customer goes to purchase some item, the customer has to mainly look at the one of the most important thing is the price. Just a general basic thing. Sometimes when you try to sell something, a lot of people they're asking back, okay, how much is it? May I know the price, please? So pricing is really important decision in marketing. So therefore, we are going to find out today in our lesson different pricing strategies taken by marketing manager, like five main strategies: cost plus, penetration, competition, skimming, and promotional pricing. So these are the five main strategies that we are going to learn today out of this lesson. Uh, when you're going to get started this lesson, we have a small introduction part. You can see setting the price is a product of a product is a vital marketing decision. And then if the price is set too high, sometimes customers may not buy the product. That definitely of when the prices are too high, customers are not like to buy the product. Conversely, too low, then they might suggest that the product is a poor quality. So this point's taken down because this kind of explanation you can analysis you can write in a 9 markers, 12 marker when the pricing decisions come. So as evaluation point, you can say when the price is too high, customers may not like to buy the product. But of course, they have general knowledge. And also when the price is too low, then the other thing happen, the demand will go up, but sometimes the customer thinking the product is poor quality. So the business might also struggle to make a profit, and businesses can use a number of methods to set their prices. So look at the examples below. You see this one, Granite Teco. So Granite Teco is a high tech gaming company. When it launched a new game, it is usually very expensive. For example, it recently launched a game called Air Dust, a game which a space was thing, and then it was the first launch in India, and it cost around 3,600 Indian rupees. However, 10 months later, it was selling for 2,600 rupees. You see, 10 months later, they reduce the price. This is another strategy. You see, most of the times they are charging high price and initially, then they are reducing the price eventually. So this product is about 28% cheaper than the original launch price. Yeah, they reduce the price after 10 months by 28%. Selling new product at a high price when they are the first launch is a common pricing strategy for some businesses. This actually we know on this one, we are learning this one properly. This is called the skimming pricing, market skimming pricing. They are charging high price. And you can see when the new iPhone release, they are doing this thing, right? When the new model comes and then they're charging a high price. But eventually after 10 months, 1 year, 2 years, you can see the market value will go down. The price will go down. Particularly those in the technology industry is very popular, very common, this type of a strategy called like skimming strategy. The idea to generate high level of revenue by selling to early adapters. There are we call now the kind of a customers we call early adapters. So who are the early adapters? In the definition here you can hear consumers who are keen to buy new products soon as they are launched. Right? Sometimes rich people are there, rich kids, rich parents. Sometimes they might buy when the new iPhone release. Soon after iPhone release, they're going to buy it. If it's not available in the local country, they might go to Singapore, they might go to the country which are available, and they're going to buy it or as a gift. So that's called early adapters. So most of the time, that's why they're like Samsung and iPhone, they are releasing in the month of November because they are making plans for the Christmas early in advance. Then people can buy, they can purchase the items in advance, and they can adapt. That's called early adapters. So before the Christmas, they are purchasing those items. So that's why the early adapters mean. So that means you can like rich people are there who can afford like even large price, expensive prices doesn't matter. Even the new iPhone comes with the $1,000 or $1,500 or $2,000, they will purchase it. They don't care about the price. That only very few. very few, about 1% of the market we can see like early adapters. 99% of the people they are not like that. They are actually waiting until the price little bit go down or until they get some promotion discount or something like that. So this is called the skimming strategy. And there are people who attach a great deal of value to buying a new technology when it first comes out, and they are prepared to pay the higher prices to be the first in the new technology. That's another thing actually that normally is true. Look at this case study. The other one, the Kowloon gift shop, right? Yuet Sheng was a gift shop in the Kowloon market in Hong Kong, and she used a very simple method to calculate the prices of each product sold in the shop. She adds 20% for the cost of buying them in. So 20% is another strategy. So even the above strategy also, they haven't mentioned the name of the strategy, but keep in mind this is a skimming. And this one, it's adding a percentage of profit margin for everything. That's kind of a cost plus pricing. So it is like a brainstorming session they are giving. So 20% she add into everything in the cost of buying in. So for example, product cost is say Hong Kong dollar 100. The selling price will be adding 20% means 100 plus 20 and 120. Okay, so you can see the prices set in above example. Both example, you can see the technology industry. They are using a skimming method, and here they are using it's a gift shop. So therefore, they are using a cost plus method. So possible advantage of this thing, you can see mainly this case, you can have a high profit margin. Sometimes when technology business, there are so many research and development costs involved attached. They can cover the initial research and development cost by charging a high price, and later on they can charge the other layers in the market by reducing the prices. And here the gift shop, always the cost plus pricing is easy to calculate, and it's always ensure that the profit is they guarantee the profit margin is there in the price. Okay, so in this lesson actually we are going to discuss mainly there's an outcome, talk about the pricing mix, and the most important thing in the marketing mix, one of the decision is price. So lesson outcome here today, we're going to talk about these methods, understand the main pricing strategies, cost plus pricing, competition pricing, promotional pricing, penetration pricing, and skimming pricing. Okay, let's see what are the factors affecting the price. So you can see here, first one, the marketing mix of the product. When you're pricing a product, whether it was a different industry, it can be a different industry, it can be a, let's say, education industry, it can be the hardware industry, it can be the tourism, the hotel industry, it can be the restaurant industry, it can be the service sector, industrial sector, whatever the firm we are operating in. The marketing mix is really important. So price has to fit with the other elements of the mix. Like it's a market product, you must have a high price you should give. An objective of the pricing to find out the pricing could be used to be achieved the certain aims like low price to drive out drivers, and also taxes, like heavy taxes on tobacco and petrol is another thing. Heavy taxes, sometimes you have to consider taxes, the government, how much taxes they are charging, that was really important. Right, and also competition. You can see the prices often influenced by the those of charged by rivals. If you are imagine if you are selling vegetables, you have to find out the competitor's price. If you are selling at a high price, sometimes no one will buy from your shop. They will go to another shop. Therefore, competition also really important, and consumer perception about the product. They wanted to value for money, so prices must reflect this, and also cost can have to be recovered, so therefore the profit is made. So prices also rise the cost as a result. So cost of the production is really important because no one wants to actually give a price less than the production cost. Now you can see all these strategies, these 5 strategies. We can mainly I can show up this chart. There are 3 pricing strategies based on cost, based on market orientation, and based on competition base. So cost-based pricing strategies, there are cost plus pricing method that we're talking right now. Cost plus method or markup pricing, we call cost plus pricing method. That is basically 100% based on the cost, but not the other thing. Like they ignore competition, they ignore other consumer perceptions and everything. They just care about the cost only. That's a limitation of cost-based pricing. But the cost-based pricing, definitely these methods are only one method they have. This is very easy to calculate cost-based pricing, because you only just know the cost that you have to calculate. So and you guarantee the profit margin of that. And under market-oriented pricing, we have these methods: skimming or creaming pricing strategy, penetration pricing strategy, psychological pricing strategy, loss leader pricing strategy, discount and sales. Right. Mainly, these are only market-oriented, which is customer-based market strategies, customer-based pricing strategy. So you have a skimming, penetration, psychological, loss leader, discount and sales, everything we are doing based on the customer perception. So that therefore we call these pricing strategies are market based. One by one, I'm going to elaborate what is skimming, what is penetration. So therefore, just this introduction part only. Therefore, I'm going to read you one by one what is this meaning. And third one, the competition based pricing strategy. You can see this is actually based on the competitors. How much this is very easy to calculate because you don't need to think about any factor. Only have to concern about how much your competitor, your neighbor, charging for their product. Imagine you are selling ice cream. If you're selling for ice cream for, let's say, for $2, right? You have to find out what is the price charged by your competitor, your neighbor. Okay, he's charging $3 for ice cream. Then you also can increase the price. Okay, $3. Like this. So competition based means mainly there are three methods: going rate pricing, that charges similar price like competitors, and price leadership. Sometimes if you have the monopoly in the market, like more powerful firm in the market, you become the dominant firm, and then you actually create prices. And then other small businessmen, small competitors, the rivals, they follow you. They are following your prices. Therefore, you don't need to search about them. They are searching. They do market research about you. That's called price leadership strategy. And third one is sometimes you're charging a very low price than your competitors to drive out them from the market. That is called the destroy pricing or predatory pricing strategy. So these kind of different pricing strategies are there. Briefly explain everything. So skimming means charging high price in the beginning and then reducing the price later on. Because this is actually like an example we discussed before, like Granite Teco, to charge the initial price in order to attract early adapters. In the penetration pricing strategy, they're using the opposite of the skimming. They're using low-high method, charging low price in the beginning to establish the market share, and then gradually they increase the price when they establish. Psychological pricing, sometimes they're using, we might be different, definitely know this pricing, like they're giving like odd numbers in the pricing, like without giving, let's say, $500, they are giving $499. Without giving $10, giving $9.99 or $9,999, right? Without giving 10,000. So that's called psychological pricing. Sometimes selling at a loss leader, so therefore selling at a low price for temporarily. So loss leader pricing. Sometimes the main product, let's say, if you're selling, let's say, mobile phone selling at a low price, but the devices, sometimes charger, sometimes the airport, sometimes the SIM card, sometimes the memory chips, accessories are expensive. Loss leader price. Sometimes they say the Netflix, the subscription is cheap, but when you actually want to download different subscription, when you want to actually buy, if you upgrade your thing, is expensive, right? You can buy the, let's say, satellite cable TV connection is little bit free, actually sometimes very low price, but when you want to subscribe the TV channels, like different channels, it will be expensive. Prices are there, therefore your package will definitely go up. Let's go the loss leader pricing. They are selling the main unit, they are selling the connection, giving very loss price, but when they know, okay, without these channels, no point of having this connection, therefore people start subscribing the television channels on satellite TV, then definitely our bill will be very high. Discount and sales is kind of promotional pricing strategy, like in Christmas season and different, Halloween season, Father's Day, Mother's Day. They are giving some discounts and sales, some particular items in order to attract the customer purchase. Everything market-oriented price. Okay, it's a brief discussion of all the pricing strategies. So let's go to the discussion of one by one. Cost plus pricing. Cost plus pricing. Here we can do some kind of a small calculation on the cost plus pricing. You can see the definition of cost plus pricing: adding percentage or markup to the cost of producing the product to get the price. The cost of manufacturing the product plus profit markup. Say that's how we are finding that, like, total cost divided by output, then we can get the unit cost So unit cost into markup, that is called the selling price. There are so many like past paper questions in MCQ questions, particularly the calculation questions are there right now to find down the selling price and markup. All right. So in there in the past paper questions right now from this cost plus pricing technique. Look at this example. If the cost of the price is 60 pounds and the markup is 25%, so selling price should be 60 plus 60 into 25%. So that is 60 into 25% is 15. So 60 plus 15 is 75 pounds. So look at this. The main advantage of this is that it ensures that all costs are covered. Definitely, when you actually cost is 60 and you're selling 75, I mean definitely cost is covered there. And it's simple to calculate. And the main advantage, the disadvantage of this method is that ignore the market condition. As I told you, they ignore the market condition. Okay. So I'm asking this question from different right, so from all of you, right? So you can actually, if you are watching this, you also can join, and also if you are hearing this, you can use the chat line to communicate. Okay, first question. Cost is 1,000, markup is 25%. What is the selling price? Cost is 1,000, markup is 25%. What is the selling price? So first one, because of first one, I'll tell you the workings. This 1,000, you can do like this: 1,000 plus 1,000 into 25%, or just you can find out 1,000 into 125%. Using calculator is very easy. 1,000 into 125%. So answer is. So I can see a couple of answers pop up in my chat line. So I can see, yeah, 2 students gave the correct answers. Yes, that's correct answer. 1,250. Right, 1,250. Yes. Okay, this one, the other question. Cost is 8,000. Markup is 30%. What is the selling price? Cost is 8,000. So you can find out 8,000 into. Straight away you can get the 130%, or you can get the 8,000 plus 8,000 into 30% and add them up. So 8,000 into 30% is 2,400. If you add them up, it's 10,400. Yeah, I can see another couple of answers. Yes, 10,400. Excellent. Yeah, I can see the same student giving the correct answers continuously. Good, excellent. Keep it up. Right. Third question. 90,000 is a cost and markup is 15%. What's the selling price?
Sir?
Yes.
So how do you take the markup as 115 or 120% when you're doing the calculation?
You can just type 90,000 into 150% and 90,000 multiplied by 150, and you can type the percentage sign, percentage sign in a calculator.
So you can just make it 100 and whatever.
Yeah.
And immediately get the answer.
Yeah, because this in this case, okay, the third question, 90,000 into
115%.
90,000 into 115%, 115, and you can see the shift and the equation button. You can see 103,500. Or else there's another method is there. 90,000 into 15% straight away you can calculate. That is 13,500, and you can press the plus button, and you can still get the same answer, 103,500. Yeah, that's an easy technique. So what you have to do, there are two methods are there. You can take the 90,000 into 115%. Then you can straight away selling price you can reach. Or otherwise, there are two-step method is there, cost plus pricing. So cost is 90,000, and you can set the 15% straight away. You can calculate from the calculator, that is 13,500, and add them up. The 90,000 plus 13,500 is 103,500. So it's very easy to calculate. So it's always ensure the profit margin, the markup percentage is there. Look at this one, 7,500. Okay, 7,500, and the markup is 20%. What is the selling price? Can you see chat line? $7,500 into 20% is 1,500. Yes. If you add them up, it's 9,000. Correct. Very good. Very good. Right. So 1,500 is the 20%. You have to add them up. So 7,500 plus 1,500 is 9,000. Selling price is 9,000. So they're keeping 20% profit margin, which means 1,500 profit they are keeping, markup So therefore, the selling price would be 7,500 plus 1,500, that is 9,000, right? So that's the first part of the pricing strategy. I think everyone can understand. Okay, this one actually, the cost plus pricing strategy, everything I have given in my short note as well. So later on, I'm going to share that with you. This one, the short note, you can see pricing strategies, everything, cost plus pricing, market oriented pricing, competitor pricing, and then, right? So today I'm going to give you at this one short note, I'm going to give you in the classroom. So in this textbook, you can see in page number 308, the factors affecting pricing is there: marketing mix, objective of the business, government taxes, competition, consumer perception, and the cost. So these are the things that we are going to mainly considering like a factors that we are affecting our pricing strategy. So that just now we talk about the cost plus pricing, the same thing in the handout is properly explained, the definition and the working calculations, everything. Yeah, the cost plus pricing, we talk about that we can ensure the profit is there, and then the organizations are normally they are really it's easy to calculate for them. Therefore, they're using this method, this pricing method always as a benchmark pricing method, like most of the time, because it's easy to calculate. Because of the organizations, they really wanted to have this pricing method because it's easy to calculate. Okay, so now we are going to actually talk about the penetration pricing. Penetration pricing, the price itself, you can see, as I told you, penetrate into the market. Like penetration means entering. Penetration means enter. So, so setting a low price to start with in order to get established in the market. It's a very important pricing strategy that we are doing. That is establishing the market. In order to establish in the market, people are using this pricing strategy, setting a low price to start with in order to get established in the market, and price may be raised once it's established. That's what we do. So they enter into the market with a very charging low price, let's say a $1. But when they have because that is a very good strategy with high competition in the market. I remember a couple of years ago in Sri Lanka, we have, at that time there are so many internet service providers and the telecommunication suppliers are there, like Dialog, Telecom, Mobitel, Hutchinson, and Etisalat, and so many. But Airtel, it was a famous Indian multinational company. They wanted to enter into Sri Lanka. So what is their strategy they have launched is penetration pricing. So at that time, they actually try to give the SIM cards like very low prices. Sometimes, let's say the Dialog SIM card selling around, let's say 300 rupees. So they are selling around 50 rupees. And later on, sometimes they give free of charge, right? If you anyone, they're giving 3 SIMs. You can pick your mobile phone number. So they are customized and they wanted to give it away. Like they just actually give a very good, like a high publicity and promotion they give. Every SIM card, there are 100 rupees top up and giving free of charge. So after that, what happened? After certain number of months, they start increasing their service charge little by little. And now what happened after about 10 years now? So it happened 10 years ago. Now, actually, they are actually really like a market share. They have around, let's say, 20% of the telecommunication. In Sri Lanka, let's say about 20% of the market share owned by Airtel. Market leader still Dialog and Mobitel. Airtel is also there among them. So they establish some market share by using their trick of penetration pricing. So that is a very important thing when someone want to enter into the market, very high competitive market. You can start with the low price, and then people will start purchasing from you. They will become more loyal if your service is good, and later on you increase your prices step by step. Then they can't actually loyal customer. They will not leave you. So 2 reasons using this strategy. It is hope that the consumers get into habit of buying the product when the price is low. So the prices start to price people continue to buy the product. Moreover, large retailers and other bulk buyers are more likely to show an interest if a product it is generously priced. Generous price in low price. Sometimes large retailers, supermarkets, for example, and wholesalers even they wanted to buy from you because they know there's a nice profit margin because it's generously priced. A lot of people wanted to their people asking like a bargain prices. So therefore, the product will be matched with the majority of the mass market people. That's why charging a high price always not because not generously pricing means uh, this is their lower prices like a generously pricing means the price tag is low. The only disadvantage here is sometimes the customers thinking this is low quality. That's a problem, right? So we are going to the third one of the day, price skimming strategy. Some people call creaming strategy. Why? If there's like the cake, icing cake, the top layer we call the cream, right? The cream of the market. The cream of the market means the top level, the top layer, high income people, high income earners, the high class people, first class people. That's called the cream of the market, top class. Therefore, price skimming always targeting this top class or first class people. Some people they call early adapters. In the introduction part, I told you early adapters. So because they don't bother about the pricing, they don't want to bargain. So whatever the price they call, they are purchasing it. So setting a high price initially and then lowering it later, that's called price skimming. Right? The main objective is to generate high levels of revenue with a new product before competitors arrive onto the scene. They are called early adapters, a group of consumers prepared to pay higher prices because they like to be the first buyer of the product, right? The penetration pricing is setting a low price to start with in order to get established in the market. Price may be raised once established. These are the reasons of we talk about this thing in my note also there. There are two reasons to do penetration pricing. First reason is it is hope that consumers get into the habit of buying product when it is priced low. And second reason, large retailers may attract this. You can have a bulk amount you can sell. If you generously priced, a lot of people can afford it. Therefore, a lot of people will buy from you. Yeah. So, number of industries in favor of this strategy because it's particularly selling to large mass market. Therefore, business selling certain fast-moving consumer goods we call FMCG, fast-moving consumer goods such as confectionery, canned drinks, shampoos, detergents may also use the penetration pricing. However, because the disadvantage, the cost of pricing strategy can be high. Sometimes the cost of the pricing strategy might be high since the profit margins will be squeezed. Because when you are reducing the prices, right, permanently because you are going to sell it at a low price, that is your strategy. Sometimes your profit margin is very low, they squeeze your profit margin. Therefore, it is also danger of a negative response from consumers when price start to increase after the introductory offer. That's the thing. So basically, penetration pricing is like that. Right. Now we'll move on to some the next pricing strategy today. The skimming is done and then charging high price. So mainly the skimming, penetration, and creaming the market actually. The penetration after the skimming pricing always keep in mind high-low method. So what is the main reason we are doing it? Because the main objective to generate high level of revenue in the initially product before competitors arrive the scene, enter into the market. Like sometimes it can be justify that in the fact that if you want to charge high price because you wanted to cover your research and development costs. For example, product like Samsung and Apple, always they have high research and development costs. They spend billions of money in order to research on new technology. Therefore, sometimes they justify, especially sometimes you can see some drugs, some vaccines are expensive, very expensive because the beginning it's very expensive, but later on they actually reducing the prices. They are doing it mainly in order to reduce the research and development cost. And there are called early adapters, like a group of consumers who prepare to pay high prices. We talk about this I think several times. So the disadvantage of this pricing strategy normally, because of the high price, sometimes people will not purchase the large volumes. That's the thing. And also when the product is become established, a firm will lower the price that normally that is like technology they happen because the product established and they actually charge everything first class people when they buy. After certain number of months or years, they're going to reduce and they charge in the second tier of the market, which is middle income people. And then after the certain year months of time or some time, like will depend on the product, they are targeting the lower income levels like that. So step by step, they're reducing it gradually. So main disadvantage of this pricing method is you have very low quantities going to sell, and product you can cover the research and development cost. But sometimes another disadvantage of skimming price strategies. Sometimes the people, a lot of people will be like like mass market product is not very appealing. This kind of product, and if you have a very good brand name only, this can be happen. If there's high competition is there in the market, so you can't actually achieve that much of profit margin out of this. So they're giving good example here. Price skimming include the innovative product like Apple, iPhone, Sony PlayStation, PS3, or PS4. So PS3 was originally sold like a 599, like a psychological pricing in the US market, but it has been gradually reduced below 200 level. It's gradually reduced to below 200 levels. So that's the thing, 500 or almost 600, and then going down to 200, which is like a 3 times they reduce the price. The pharmaceutical companies, they use skimming pricing. They sell new drugs for high prices when they are first launched. However, when there are patents or legal document which reserved copyrights for an intellectual revenue, expire, competition emerging, they price. As I told you, pharmaceutical industry also like that. In the beginning, they charge high prices. After they expire their patent rights, because pharmaceutical industry, after innovation, after invention of a new drug, they give 15-year monopoly time period in order to capture the market, sell that product. So 15 years, the price will be very high, but later on, you're going to reduce it. And also the fourth one today we're going to discuss is the competitive pricing or promotion-based pricing. There are different pricing strategies, as I told you, price leadership and other thing. This main focus on this price is not the cost, is competition. It's very easy because you don't need to actually that much tire. It's not a tiring work. Only you do a small market research. You can use even the website and go and see what amount of prices they charge by other companies. If it's a hotel, you can easily find it because they're available in the website, hotel prices, room rates. Even restaurant, you can see the menu, sometimes the available prices, everything, price list, everything available. So KFC can always, the Domino's pizza can always, they go to the pizza and they can find out their prices. It's very easy now. So only thing, you have to focus on the competitors. So you are closely charging with this like a same or lesser value like a competitors. So pricing strategies based on this price is charged by rivals. You can see when the product is priced in line with other or just below the competitors, price to try to capture the more of the market. Like that's the thing, because you're also selling 10. They say face mask, right? I'm also telling at $1. You're also selling at $1. So then people actually, there's no difference actually in the prices. So everyone is the same. So there is no difference. Everyone will go to any shop, they will purchase the item that they want. So and also it's a price, there is no price war. Sometimes if you charge low prices than the computer, there is a price war, right? So if you charge the same price, there is no price war avoid. You can avoid the price war because it's a friendly approach, because there is no competition. Then he also charging same price, you also charging same price. If you charge less price than him, then he will be little bit upset that the competitors and rivals be upset about you, and then they also charge to start increasing their prices or decreasing their prices. They react. So there is a price war coming up after that. So there is nothing happened because of this situation, because you have good understanding between the rivals, therefore they are charging the same prices. So if it's a cartel or something is there, I think in economic you might learn this, like collusion or cartel. So you can merge everything. Like I said, the biggest cartel in the world is OPEC, Organization of Petroleum Exporting Countries. So so the world oil barrels, like crude oil, actually the price of the crude oil price is actually determined by the OPEC. So they give the quantities also, and everyone actually want to know, okay, how much they are going to sell. So there is no competition happen in this respect. So Another reason that the price competition is okay because of the considered to be a safer pricing strategy. It's very safe. Okay, so in under the competitive pricing strategy, there are certain techniques are there. As I told you, price leadership. If you are the monopoly, if you are the dominant firm in the market, you can use a price leadership strategy. How? Market leader always set the prices and others will be follow. So subordinate will follow you, small businessmen will be follow you. So because you are the dominant, they always think, okay, how much their prices. So we also amend our prices like that. Like if it's a bigger supermarket, let's say Walmart. So if based on their prices, sometimes others also they are charging. Like Amazon prices sometimes affecting to other websites also. Like that. So everything is based on the competitors, the price leader. So if there is a price maker, there is a price leader, and others are followers. So dominant in the firm in always doing that. So it can be the low cost producer. Business that follow the leader maybe have higher costs, therefore have to accept the lower profit margin. So that's it. So always organizations who follow in the dominant firm must be very careful with their costing part, because if the lowest lost leader sometimes can be a leader will be very cost effective person, and then that leader's price is really low means that means you also have to reduce your prices, which means you have to squeeze your profit margin. And there's another method called like a non-price competition methods are there. We're talking here like non-price method of competition. Like in competitive market, sometimes people like not from the pricing, they are charging with the like let's say after sale service. Sometimes product which is very similar, engage with non-price competition. This might involve special promotions or strategies designed to differentiate the products. That's called the non-pricing strategies. For example, you can give like let's say delivery service, free delivery service, after sale service, like sale with a smile, some non-price strategies. So like fresh and also very hygiene environment, like very good working conditions, non-price competition. And the destroyer pricing or predator pricing, right? That also keep in mind a little bit, like sometimes some firms are charging very low prices in order to drive out the competition from the market. This is illegal, but there is this pricing strategy also happening in the world. Therefore, you should add this part also into your knowledge bank: destroyer pricing or predatory pricing. This is happening because mainly like a large multinational firms, when they want to establish their market and they want to drive out the other businesses from the market, they want to, let's say, erase the competition from the market they are doing. The aim is to lower there for the period of time, make it difficult for rival to compete. If the strategy works, some rivals would eventually leave the market because they can't actually right. So they can't tolerate this because everyone start go to buy everything from your competitor and you can't sell at that price. So the predator becomes more powerful at that time when the competition is low. And then what happens? The predator will now have a larger market share, and then he will start increasing the prices again. A good example I can give it 2009, the Amazon, they actually start selling books to France without charging their shipping cost. But other booksellers in the market, like France, they have actually complained this about the France, the legal system, and then after that the court ordered to Amazon, no, you have to charge the shipping cost and sell. Otherwise, the industry will be it's unfair for the local booksellers who are selling the books with the shipping cost. They can't afford it because you can afford it because you are doing other imports as well. But other small infant businessmen who are in the book business, bookshops, so they actually complain about this, and Amazon has to pay 1 billion euro fine to the France government because of this. That's an epic example. You can see the destroy pricing is not working sometimes because this is illegal method of it's an unethical practice. That's why. Okay. So I think we have enough for this lesson. I think we have discussed 4 methods today: competition pricing, skimming pricing or creaming, and penetration pricing secondly, and the cost plus pricing methods. So today actually our main lesson was actually introducing the lesson, the pricing strategy. What we discussed today is the pricing main strategies, and then the factors affecting pricing, the marketing mix, the objective, taxes, competition, consumer perception, and cost. And also we introduced everything, all the pricing strategies today: cost plus pricing, skimming pricing, penetration pricing. So 4 pricing strategies we discussed today. So in my next session, we are going to see you about in my next session on Wednesday. I'm going to give you a psychological pricing and also promotional pricing strategy. You can see this kind of approaches like promotion pricing, 25% off for Sampath cards or in Apico. Like or lastly, sometimes this discount price you can see the prices they charge like that. Sometimes sometimes they are look at the prices they charge 854,999, right? And 10% off 65 curved UHD 890,099. So why they're giving 99 here? That's called psychological pricing. What numbers? Always they are giving some kind. This kind of thing in descriptively we'll talk about in my next session. And also you can see we are going to discuss some MCQs and also some past paper questions also. There you can see there are 9-mark questions came in 2012. Like option 1, promotion pricing, option 2, competition pricing. So still we can't do this because we haven't discussed the promotional pricing yet. Competition pricing is, we discuss right now today. It's a pricing strategy based on the competitors. Charging the same price like competitors, we call going rate pricing also there. So we are talking about that thing. So this is, you can see the competition pricing, the marketing scheme also they say. By using this method, they will be selling the chocolates in line with other competitors. So benefit. So it's a chocolate industry. That's why. So whatever thing that you're going to write, advantages and disadvantages, apply to the case study. So that's a 9-mark question structure. 2 advantages and 2 disadvantages of the selected option. And 2015 IGCSE they asked what is cost plus pricing. So you can answer this today because we discuss this right now. What is cost plus pricing? Definition they're asking. So I think the new syllabus it should be not 3 mark, it should be like a 1-marker definition. So we're charging a price by adding a markup to the cost. So that's a selling price. You can give the even the formula also that correct, right? Cost plus pricing means it's a pricing technique which is adding the percentage of like a markup to the cost of the product. That's called the cost plus pricing. Even when this kind of question, you can even explain with the example also, right? And then this definition section, everything is important. So 1-mark definition question can become to define these pricing strategies. 2-mark calculations questions can become from pricing techniques, like we discussed before, and also like this 2-mark calculations. And then this kind of a questions, name suitable strategy. So for new iPhone, I think skimming pricing will be good. Like daily newspapers, I think competition pricing will be good. T-shirt, I think which price? I think promotional pricing will be good. And horse race definitely the premium pricing strategy. The customer-based pricing is good. Right, pair of shoes. Sometimes you can see promotional pricing is good. Prepaid card, you can see like a dialogue card or whatever. 99 internet cards, 99,999. Psychological pricing is good. Lunch packet, I think going rate pricing is good. That depend on the restaurant, so you can see. So this one different. The applications are there on pricing. Okay, then I think today the first session was okay. We talk about these things. So in next day, you'll see you in my next session. Thank you very much. See you next time. Bye.